Good evening, sir. We will begin in a minute.
Sure, Vishaka, take your time.
Good evening, everyone, and welcome to the final round of Investate 2022, the National Case Study Competition of IIM Raipur. First of all, congratulations to each and every team out here for making the final six. We have gone through your work and are thoroughly impressed by your detailed analysis. Hope you keep up the same during the presentation as well. Let me now introduce our judge for the day. Dr. Nemirada Jadiyappa is an assistant professor at Indian Institute of Management, Raipur. He holds a PhD degree from IIFI Institute for Higher Education, India. He was a visiting faculty to the Spear School of Business, OSU, USA. His research interests include corporate finance, corporate governance, CSR, creditors governance, and earnings management. His research papers have been published in the top-tier international journals like Emerging Markets Review, International Review of Finance, Economic Letters, and International Review of Economics and Finance. Before we get the thing started, I would request our judge to share a few words with our participants today. So you're on mute. So you aren't audible.
I'm sorry, you're putting me in trouble, Vishaka. I was not ready for this. All right. Now, welcome to all of you. All the teams have, I went through a few of the slides and those guys have done really a good job. Now, of course, there's going to be only one winner. It doesn't mean that other teams have done bad. It's only based on the comparative basis I'm going to judge, okay? So if you are not getting any place, don't feel bad. All the projects, they deserve to be in the winning place, but unfortunately I have to decide only one. Okay. So all the very best, do good. Thank you, Vishaka. You can go.
Thank you so much, sir. So now let me brief everyone about the rules once again. The time allotted for presentation is 10 minutes. You would receive a reminder at 9 minutes via message on the Zoom chat, and there would be a hard stop at the end of 10 minutes. The presentation would then be followed by a Q&A session. So make sure that you turn on your video and raise your hand while presenting. At other times, you must keep yourself on mute. Now I will pass on the moderator to Suresha Chitranshi.
Okay, so we will have presentations now in the order that was shared before. So for the first presentation, we have the backbenchers from SCMHRD Pune. Can you all please raise your hands? Yeah, you may share your screen.
Okay.
Okay.
Is my screen visible?
Yes, it is visible.
Okay, thank you.
You may start now.
Okay. So, good evening, everyone. My name is Sarpit Mahajan, and this is my friend Himanshu Shah, and we are the team Backbenchers. Our presentation is on the oil and gas industry, where the acquirer is Vedanta and the target is BPCL. Himanshu, can you go on to the next slide? Vedanta Limited is an Indian multinational mining company with its main operations in iron ore, gold, copper, and aluminum mines. It is the holding company of Can India, which is the largest oil and gas exploration and production company in India. Can contributed to around 24% in India's domestic crude oil production in FY20 and has a vision to produce 50% of India's oil and gas by 2040. The government is also seeking to privatize BPCL by selling its near 53% stake in the firm through OFS method. Vedanta Group is willing to acquire BPCL. Vedanta Group portfolio is missing oil and refining and marketing. This deal will have Vedanta set itself as an end-to-end oil and gas conglomerate unit. The BPCL has already had a network of 15,400 fuel stations with 13,648 fully automated stations. It also owns a network of 2,241 kilometers of multi-project pipelines. So by our analysis, the combined entity will have higher synergies, higher combined EBITDA, and higher end-to-end oil conglomerate. So by these reasons, we are recommending that Vedanta should buy BPCL, and the reasons for the same will be given in the next slides. India's energy demand is expected to double to 1,500 million tons by 2035 from 750 million tons in 2020. Crude oil, coal, and natural gas are still the main resources of energy in India. Crude oil consumption is expected to double to 500 million tons by 2040 from only 222 million tons in 2020. India's crude oil imports are also increasing sharply, which is a good opportunity for corn to extract more oil from India and reduce oil dependency on oil imports. Coming to Porter's five forces analysis, there's a low threat of new entrants as high capex is required in the oil industry and also volatile international politics and geopolitical tension in the oilfield regions. The buyers in the oil industry have very little bargaining power over the pricing of crude oil and natural gas as there are no cheaper alternatives available. Suppliers in the oil industries are the oil extraction companies who have moderate bargaining power. Government contracts also influence their bargaining power. There's a high possibility of substitution in future through alternate energy, which is cleaner as well as renewable. The competitive rivalry is also very high in this industry due to the presence of few large-scale players. Profit margins are thin as companies have to set up their price to match competitors' price as well as government regulations. This is a graph of oil and gas producing regions, and Vedanta already owns oil fields in Gujarat, Andhra Pradesh, and Rajasthan, which gives a benefit over other companies. Can you go on to the next slide? We have already discussed about the Vedanta, but by looking at the chart on the bottom left of the screen, we can see the revenue as well as earning breakers of Vedanta, from which we can infer that most of the revenue as well as the earnings of Vedanta come from majorly three segments: copper, zinc, lead, and aluminium. But only 2% revenue and just 3% earnings from the power segment. Thus, Vedanta would want to diversify its product portfolio and enter into oil, refining, and marketing. From the second graph, we can infer that the Indian demand for metals is greater than the respective global demand, which is good for Vedanta because Vedanta is a molding company. But oil demand for India is much more than the global demand. Thus, this deal will have Vedanta exploit this perfect opportunity and make more money. Can you go to the next slide? About BPCL. BPCL is headquartered in Mumbai and it operates two large refineries in Kochi as well as in Mumbai. BPCL operates around 19,000 oil retail outlets across the country. The company is into exploration and retailing of petroleum and petroleum products. Its subsidiaries are Indraprastha Gas, Petronet, and Bharat Renewable Energy. From the graph on the left lower side of the screen, we can see that the EPS is continuously increasing except for the year 2020, and the sales volume has also been increasing from 2016 to 2021 and is supposed to increase further. So by these two things, we can infer that increasing EPS as well as increasing sales volume are a good sign for acquisition for BPCL. Now Himanshu will continue from here on.
Thanks a lot, Arpit. And hello, everyone. The subsequent slides will be just the quantification of the deal to carry out for the mergers and acquisition between Vedanta and BPCL. We have performed the financial modeling for both Vedanta as well as the BPCL. BPCL being the target, its detailed valuation is what you can see on the screen. To start with, we have forecasted the revenue of BPCL based on the business segments of petroleum products and other than that, the exploration of crude oil. The petroleum product is forecasted based on its volume, which is expected to see a declining growth rate, and its unit price, which is showing an increasing growth rate. The other segment is the exploration, which is showing a high increase in growth rate due to Government of India initiative of reducing crude imports and make India self-reliable. As the capacity utilization of BPCL is near 100% currently, its capex tends to increase by 12% year-on-year in future years. DNA is calculated basis the gross block, which in turn is the addition of capex. Finance cost calculated based on the debt, which in turn is calculated based on the excess funding which is required for the capex after utilizing 60% of its EBIT for its normal operations. The WACC, which you can see on the screen, turned out to be 8.8% calculated by the CAPM method. I myself was intrigued to see such a low debt rate for this company, and accordingly, I found out that the company has AAA rating. It enjoys lower interest rate due to foreign bonds, and also it is having interest-free debt from Government of Kerala. We have assumed terminal growth rate of 4%, and our DCF calculation shows the value to be 458 rupees, which is 22% upside with the current market price. Likewise, at the bottom left, bottom right, there's a sensitivity analysis of the same. Now, coming to the next slide is the relative valuation of BPCL. We have identified its peers in India with similar business functioning. We have used EV by EBITDA and P multiples to find its intrinsic value. After obtaining that, for obtaining the final value of BPCL shares, we allotted the weightage of 60% to DCF, 30% to EV by EBITDA, and 10% to PE multiple as per the business nature, and obtain the intrinsic value of 488 rupees, which is 31% upside from the current market price. One thing to highlight here is that the intrinsic value that we have obtained is in line with the broker consensus of ICICI Direct, Motilal Oswal, as well as the JPMC. Now, coming to the next slide, this slide shows the synergy and accretion dilution analysis. The synergy is applied only to the oil and gas segment of Vedanta, while other segments have been untouched of Vedanta because it will be having very minuscule impact on it. Revenue synergy is mainly due to consolidation in oil and gas industry, as stated by Deloitte industry reports. The customer base which BPCL has can be extended for both petroleum products as well as the natural gas, expanding its revenue synergy. This synergy will arise from FY23 itself very minutely, but is expected to reach 0.25% till FY30. Major factor of combining the entity is its cost synergy. The combined entity may prove to be end-to-end oil conglomerate, thus establishing the cost-efficient supply chain. Employee benefit expense will reduce quickly due to workforce integration. However, in the initial years, what we have seen is that the additional cost to integrate the business by establishing the supply chain, there will be a negative cost synergy initially, but as the time will progress, the cost synergy will increase to 1% till FY30. Overall, this synergy will be negative till FY26 because of higher cost, but it's going to increase till 1.25% till FY30 with accretive EPS of around 25.9%. Now, coming to our final slide of deal structure, what we have valued for the BPCL, we can provide 25% premium for acquisition of it. As Government of India is looking to divest its shares in BPCL, no mandatory share capital is required for them. We have assumed the maximum debt raising capacity of Vedanta to be debt to EBITDA ratio of 2.5%, as in consensus with the capital intensive industry. Also, everything cannot be used for acquisition, and hence the minimum cash to be left with Vedanta is 1.5 times the PAT of the coming year to cater any anomalous or difficult times. As it turns out, the financing modes will be 48% of debt, 44% of stock, and 8% of cash. This will cover the enterprise value of 1,43,000 crores and advisory fee, which is 2% of the enterprise value, and the financing fee, which is 0.15% of the debt that is getting raised. Keeping this combination and its relative cost, the cost for the buyer turned out to be 7.7%, while the yield of seller was 10.4% at the time of purchase. Thus, this acquisition will be a net accretive transaction when carried out with this deal structure, and Vedanta, in its true sense, will be able to consolidate its position in oil and gas industry in India. Thank you.
Sir, you can ask your questions now.
Oh, okay, thank you, Chitranshu. Now, guys, a good presentation. I just have one or two doubts. So you have calculated the cost of capital to be somewhere around 8.8%, right? If you go to that slide, the cost of capital, I think here, 8.8% back, right? So
Yes,
beta
sir.
seems to be very low, right? 0.88. Typically, this industry is, cyclic industry. It grows with GDP. So typically, cyclic industries have a beta of greater than 1. Your beta seems to be 0.88. It's on the lower side. How did you calculate? Did you consider levered beta or unlevered beta?
Sir, actually, the beta has been taken from the Bloomberg terminal. They have calculated basis the Bloomberg. What they usually do is they take the Nifty as well as they take the moving stock of the BPCL, and they have itself calculated. So this beta is what we have taken, and it is, I think, the levered beta.
This is levered beta, right? If it is a levered beta of 0.88, and what is the debt to equity ratio? So this is the debt to equity ratio around 130, right? 80 plus 60, 140 divided by 60. Debt to equity ratio of around how much? Around 40%, right?
Right, sir.
I don't know. You should have ideally calculated it because it seems very low, and with a debt to equity ratio of 40%. That seems very low, and overall WACC of 8.8%. That means it's not that you have done anything wrong, but you should have thought over that. Okay, calculation wise you have done right. You should have thought over that. 8.8% is too low, right? No,
right,
just,
sir.
Given the risk of the industry, it is too low. Okay, that is my point. Okay, you can answer that.
Yes, sir. Like even when we have obtained this 8.8% of WACC, like even we were confused somewhat that how is it coming so low. But what we have identified is that their cost of debt itself is very low. So that was the major reason why the WACC has turned out to be so low. Because Vedanta is not having such a liberty. Like the debt of it is like 6.9 before taxation, which is very minute. They are having multiple scenarios.
No, right.
And yes, we understand. Yeah, we understand for the beta point of view. We would have cross-checked it once more, and we would have calculated ourselves.
Okay, all right, that's okay. So you are saying that you are going to acquire with what is the amount of debt? So how much debt you are going to use?
Sir, it's around 43 to just a minute, sir. Yeah, debt is 47.8%. Like
so almost 47.8%. So the current structure is 40%, and you are going to use 47.4. So overall debt proportion is going to increase once this acquisition is over, right? For Vedanta.
Right.
Now that would impact your cost of equity, right? Because 40 to 47%, it is going to impact your cost of equity, and it is going to impact your cost of debt as well because debt proportion is increasing. Then there is a possibility that the valuation could go down, right?
Right.
So if the cost of overall increases, so have you considered that aspect in your calculation?
Yes, sir. We have considered that aspect, and if you can see on this slide itself, the cost of debt was originally 6.9%, while we have taken it the 7.5% over here because we were cognizant of this issue that it's going to be increased, and even its cost of stock which is there, we have considered it marginally higher than its original WACC. So yes, this is somewhat we have taken into consideration.
Okay.
And we have also and we have also kept the overall debt, like the debt is going to increase, but we have also assumed that the net debt to EBITDA ratio which the capital intensive intensive companies look at, we have assumed maximum to be 2.5 times. So that the debt part doesn't exceed that.
Okay, any idea what would be its debt coverage ratio once the acquisition is done with this proportion of debt?
So debt coverage, so we have to calculate that.
Okay, all right, no issue. Only last point. So if you go for the relative valuation, PE ratio,
yes, sir.
Bpcl seems to be having the lowest one, right? 3.3x compared to all other ones, 5.8, 7.7, right?
Right, sir.
Yeah. So no, the market is irrational, right? It is not irrational. It is rational. If it has given 3.3x value, that means there should be some reason. Now, did you explore why market is giving that 3.3x value?
Sir, because we are having 2-3 reasons in our mind. The number one is that ESG factor, because the company the domestic institutional investor, they consider ESG factors to be very much, and BPCL being into the petroleum industry, it is having like very poor score in ESG terms. And when an institutional investor particularly invest in that, their overall portfolio ESG value goes down, which they have to maintain at a particular height. So that's one of the reason. Another reason is that they also give out huge dividends as well. So that is probably one of the reason that they are not pouring more into the growth perspective, but they are delegating the cash to their investors and shareholders.
All right, guys. That was a wonderful presentation. Okay. All the best.
Thanks a lot, sir.
Thank you, team. Thank you, sir. So for the next round of presentations, we have team randoms from IIM Indore. Can you please raise your hand? Yes, you may share your screen.
I hope the screen share is coming through.
Yes, it is. You can
All
start.
right, so we'll be starting. All right, thank you. So good evening, everyone. I'm Lokesh from Randoms, and with me are Janit Sethi and Aditya Bhagwat, and we are from Indian Institute of Management, Indore. Today, we'll be presenting a case of merger analysis in the automobile industry. There were many different propositions given from various different industries, but we decided to go ahead with the automobile industry. Over there too, the original proposition given to us was a merger between Bajaj Auto Limited as well as Endurance Technologies. However, we decided that the deal was not quite lucrative, and so we suggested an alternative, that is a deal between Bajaj Auto Limited and Amara Raja Batteries Limited. A detailed analysis which will explain the rationale behind the choices will, however, large a mix of cash, debt, and equity to finance the merger deal, and a detailed analysis show that the deal to be quite accretive. A few synergies which we discuss later which justify this merger include ease of diversification and cost reduction.
Okay, so we conducted an initial comparable analysis of the proposed mergers for a deal selection. The Vedanta and BPCL deal has been rejected due to Vedanta's lack of liquidity, rising financial leverage, and inconsistent credit rating track record, which would lead to risks of default. For Torrent, Pharma, and Aarti drugs, the potential synergies of horizontal and vertical integration cannot be achieved due to the supply chain crisis, and Torrent Pharma's expertise only in niche marketing, which is not suitable for Aarti's fast-moving pharma products. As for Bajaj Auto and Endurance Technologies, the benefits of vertical integration are overshadowed by low expected growth rate of two-wheeler market in India. Lastly, due to Bajaj Auto's foray into EV market, a merger with Amara Raja can help Bajaj benefit from ARBL's R&D investments in electric vehicle battery and access to after-sales market for an early mover advantage into the highly lucrative EV market with cheaper alternatives, as battery comprises of 70% of an EV's cost. Thus, this deal is accepted.
That's it.
Next slide.
No, sir, I think our teammate is lagging a little.
The overview of automobile industry focuses on identifying the key aspects in each stage of product development chain, starting with R&D and product design to marketing and service of the product sold. It is clearly known that the two-wheeler market segment is the biggest, led by Hero MotoCorp, but closely followed by Bajaj Auto. The key growth factors for this industry not only remains to be domestic sales, but also exports, advanced R&D, and policy support from the government norms. The industry is highly rivalrous and difficult to enter, and currently is observing changes in terms of engine regulations, GST impact, and a greater shift towards electric vehicles. Next slide, please.
Okay, so for the overview of the Indian EV battery industry, we undertook a product value chain analysis and Porter's 5 forces analysis. What can be inferred is that even though barriers to entry are high due to the lack of infrastructure and resource availability in India, the higher growth potential and positive key trends in the form of prospects for mass EV adoption, high bargaining power of suppliers, and governmental policy support make the EV battery industry a sector destined for success.
Both Bajaj Auto and Amara Raja batteries have been one of the top performers in their sector for a significant period of time, with well-established distributors network and India-wide coverage. The brands have represented quality, performance, and durability to their customers in long run and have a very positive market image too. They depict a strong sales and profits year over year while maintaining quality balance sheets over the time. Next slide, please.
So we will now move on with the ratio analysis of the acquirer and the target company. So starting with Bajaj Auto Limited, we observe that the ratios of Bajaj Auto Limited have beat the global industry averages almost every aspect. So this implies that Bajaj Auto Limited has better returns, higher profit margins, and is much more efficient when it comes to utilizing the assets to generate revenue. It also has better liquidity positions than a global average firm in the automobile industry. We also observe one peculiar thing, that the average cash conversion cycle for Bajaj Auto Limited is negative. One more thing to observe is that the net income margin has been stable over the years, and that combined with a more or less stable and a low days of inventory outstanding implies that the Bajaj Auto Limited is quite efficient when it comes to inventory utilization. One more thing to observe over here is that the average days of payable outstanding for Bajaj Auto Limited has been quite higher than the regular industry averages. So this might probably imply that Bajaj Auto Limited delays its payment to the suppliers in order to maintain a favorable liquidity position. One last thing to notice in the ratio analysis of Bajaj Auto Limited is that we observe a considerable decline in the current and quick ratio during the initial years of the pandemic, which might reflect the cyclicality of the industry as well as of the firm. Now, coming to the ratio analysis of Amara Raja Batteries Limited, we again observe that this company too has beat industry averages in many aspects. One more thing to notice over here is that days of sale outstanding and the average days of payable outstanding is quite lower than the industry averages, which might mean that the credit terms are stricter both for the consumers as well as from the suppliers. The profitability and margin trends over the years have been more or less stable, but a slight downward trend is also easily observable over here. Moving on, we then try to evaluate or financial valuation. We try to carry out a financial valuation of a target company, which is Amara Raja Batteries Limited. We first started with a comparable company analysis of it, and the implied valuation which arose out of this process was not quite convincing given the high range and the very high mean value, which probably implied that Amara Raja is grossly undervalued. So we moved on to a much more extensive valuation of Amara Raja Batteries Limited using the DCF valuation process. So we built in 3 cases into the DCF valuation process. The base case, which assumed the revenue 5-year CAGR to be around 12%, and a bear case where the revenue CAGR was around 10%, and a bull case where we assumed the 5-year revenue CAGR to be around 14%. And the rest of the things were accordingly forecasted for every scenario. Then came the time to calculate the weighted average cost of capital, that is the WACC. So starting over here, we first try to arrive at the equity beta. And what did we do for this was that we first calculated we first ran a regression on the monthly returns of Amara Raja Batteries Limited with respect to the monthly returns of Nifty 50 index over the last 5 years. The resultant slope coefficient was taken as the beta, and that was around 0.9. Now this was quite close to 1, which implied that the share prices of Amara Raja moved in tandem with that of the market. We also observed that the proportion of debt was quite less in this company, and ultimately the weighted average cost of capital turned out to be 12.2%. With that as the weighted average cost of capital and a terminal EBITDA multiple of 9.6 times, the fair value of Amara Raja turned out to be rupees 729.43 rupees, which implied that it is slightly undervalued at the moment. In fact, even for the bear case, for most of the values in the given fair value range, Amara Raja was still quite undervalued. We then drafted up the sensitivity tables, and we observed that the change in the fair value with respect to changes in WACC was more or less same. The percentage value was more or less same for different values of terminal EBITDA multiple as well as revenue growth rates.
Now we will look at the merger analysis. We'll start with exploring the synergies, then risk, and further we'll move on to the pro forma model, income statement, goodwill generation, and quick accretion and dilution model. The rationale for the merger remains that to sustain and take advantage of vertical integration in its processing, Bajaj Auto needs to address its pressing requirement of batteries, a crucial component before going for vertical integration for parts manufacturing in its chain. On the cost-saving aspect of this merger, Bajaj is projected to have reduced supply cost, less delays, and component customization, which will thus result in better pricing, service, and inventory management for the customers, and thereby increasing the revenue of the company gradually. However, there remains the risk of addressing the large portion of aftermarket sales, where Amara Raja was most active prior to its merger. There can be further conflicts in listing priorities for the business as they move on from aftermarket sales to customized supply for Bajaj Auto. Next slide, please.
We will now look at the numbers side of the merger between Bajaj Auto Limited and Amara Raja Batteries Limited. So we decided the merger to be financed with a mix of cash, debt, and equity, with 25% for cash, 45% for debt, and 30% of equity. The rationale for issuing debt over here was that Bajaj Auto Limited already has a very high credit rating, and at the moment it is essentially unleveraged company. So any prior debt obligation payments will not interfere with the debt that is being issued to finance the merger. We then calculated the things accordingly and observed that a significant amount of goodwill was being generated, and there was also modest accretion of about 7.5% in the initial 2 years. That is, the EPS of the acquirer was growing by about 7.5% post the merger. So in the conclusion, we'd like to say that the deal between Bajaj Auto Limited and Endurance Technologies was not quite lucrative, given it was simply a vertical merger and not at all forward-looking. However, a better alternative would be a merger between Bajaj Auto Limited and Amara Raja Batteries Limited, given the numbers also pave the way for such a merger. That is, Amara Raja Batteries is slightly undervalued, and there's significant goodwill being created, and the merger is also quite accretive. Therefore, the merger between Bajaj Auto Limited and Amara Raja Batteries Limited is the way to go. Given the financial side, given the number side of it, and also that it is quite forward looking, which will help in the diversification of Bajaj Auto Limited and its foray into the up and booming and quite lucrative EV industry. Thank you.
Thank you, team, for your presentation. Now I would like a judge to go forward with questions.
Okay, thank you. And good work, guys. So I just have a few doubts. See, whether you are recommending merger or acquisition. So in your slides, you have written acquisition. But when you are speaking, you said merger. So what you are actually recommending, merger or acquisition?
So we are here talking about an acquisition of Amara Raja Batteries Limited as a whole.
So acquisition, it's not merger, right?
Yes, sir.
Okay, good. Any rationale why you are not recommending merger? Why you are recommending acquisition?
Sir, I would say that Amara Raja Batteries is moving forward towards looking into the lithium-based battery, that is the EV sector, and in order to benefit from the to avoid battery shortage shocks that Bajaj Auto is already facing. So there has been reports wherein Bajaj Auto has been saying that they are looking for local players to acquire and not to depend upon global players, where the cost factor also comes into play. And also Bajaj Auto would not have to look into the R&D investments that Amara Raja is already looking into. So that is why we are proposing an acquisition of Amara Raja Batteries.
If you look into Amara Raja's expertise, it is expert in acid batteries, right? Whereas this Bajaj requires lithium-based batteries, right? Now there is there's an issue. So for EVs, you need lithium-based batteries, whereas Amara Raja is an expert in acid-based batteries. And don't you think if Bajaj acquires Amara Raja, then there is a mismatch in the requirement?
So the main streamline business of Amara Raja does at the moment come from acid batteries and aftermarket sales for two-wheeler, three-wheeler, and four-wheeler. However, they have also been a main contractor for many government-led organization, defense sector, as well as railway for lithium batteries. They have made heavy investment for lithium batteries going forward into the future. So as of now, they stand as the leading promoter for the lithium batteries in India. So it is wise to acquire them at this moment, given the strategic advantage that Bajaj will have in the long term.
Okay. So if you go to your valuation, you derived a value for Amara Raja, right? 124, something like that. So please go. Okay, what was the cost of capital you guys used here?
So weighted average cost of capital turned out to be 12.2%.
Perfect. See, in this cost of capital, you assume no debt, right? You assume no debt. There is no debt in this 0.9.
We
right?
actually did not assume, sir. The capital structure that was presently they had, that came out to be that there was not significant amount of debt in the company.
No issue. So they don't have, practically they don't have any debt. Because of that, the WACC is 12.2. Given this WACC of 12.2, the equity value is 124,595, right? But when you are proposing to finance that, you are using debt to the extent of 45%, right? The moment you use debt to the extent of 45%, then you have to use the debt adjusted weight of weighted WACC. Then you should have used this equity beta adjusted for 45% debt. then you should have found out a new WACC which would have reflected that 45% debt. Then the value would have been much lesser than what you have proposed, right?
All right, sir.
No, this value would be true if you are not using any debt to acquire that. But you are saying that you are going to use 45% debt to acquire this, right?
Yes, sir.
So then if you are using 45% to debt to acquire this, then your cost of capital would be much higher than 12.2. In that case, the equity value would be much lesser, right?
Okay. Yes, sir.
Okay.
We'll
Look into that. Otherwise, it was a wonderful project. You did a good job. Okay.
all right. Thank you, sir.
Okay. Thanks so much.
Thank you, sir. Thank you, team. So for the next presentation, we have team non-performing assets from IIM Ranchi. Can you please raise your hands? Yeah, you may share your screen.
Yeah, I'll go ahead. Can somebody just confirm if my screen is visible?
Yes,
Yes,
it is.
it's visible.
All right, Shransh, you go ahead.
Good evening. We are team non-performing assets from IIM Ranchi, and we are here to propose the acquisition of Endurance Limited with Bajaj Auto. Endurance Limited is an automotive component manufacturer with competence in aluminum die casting, suspension and braking systems, while Bajaj Auto is an OEM for two-wheelers and three-wheelers. We are proposing a 100% stock-to-stock deal for the price of 19,455 crore, including a purchase premium of 19.89%, which we believe is based on these 5 pillars: EV adoption in the coming years, backward integration opportunity for Bajaj Auto, plant proximity between these two companies, management synergies, and most importantly, financial synergies, as we are expecting the EPS accretion to be around 35 to 50% in the forecasted period. So before coming to the acquisition, let's talk about the industry. The production trends in two-wheeler and three-wheeler manufacturing is showing a declining trend over the last two financial years, primarily driven by economic slowdown in 2019, which was further worsened by COVID pandemic. The demand is expected to pick up this financial year onwards. Talking about the market segmentation, driving and steering transmission, suspension and braking parts, body and chassis constitute 43% of the revenue generated, which are the primary segments for Endurance Limited. The automobile ancillary industry as a whole is expected to register a strong CAGR of 15.35% over the next 5 years. Coming to the target company, Endurance Limited is the largest two-wheeler, three-wheeler component manufacturer in India, with 27 manufacturing plants across regions in India and Europe. Bajaj Auto continues to generate half of the revenues for the company, while non-Bajaj two-wheeler manufacturers like Honda, Hero MotoCorp, and Royal Enfield are increasing their revenue contribution over the last 6 years. India operations generate around 3/4 of the revenue, while Europe also registers a sizable 25%. Talking about the financial analysis, Endurance is expected to register a stellar revenue growth and stable utilization levels in the forecasted years. Historically, it has shown stable profits and a healthy liquidity position. Now I would like Akshay to take.
Thank you, Shriyansh. So talking about the strategic rationale. So first we'll talk about the individual strength of Endurance. That are the key highlights. So first of all is the new order wins, which the company has been successfully winning over the past period, as well as in the current financial year as well. Moreover, the shift of focus of the OEMs as well as the governments on the EV adoption has also been witnessed for the company, and it is supporting the growth. Moreover, the increased diversification in the high-tech products as well as the increasing capital expenditure that the company has been incurring to expand its capacity are the key highlights that make Endurance a good company for the acquisition. Not talking about the synergies that will come into play. So first is the EV play. The acquisition of Endurance will definitely allow Bajaj Auto to create a competitive single source entity to design and manufacture high quality systems in the EV segment. Moreover, it will also allow backward integration for the Bajaj Auto, enabling supply chain efficiencies as well as lower cost. Plant proximities is another reason where synergy will come into play, and lower transportation costs will be incurred for Bajaj Auto. Moreover, Bajaj Group has helped scale the business of Endurance Limited, since Anurag Jain is the nephew of late Rahul Bajaj, and hence the two companies share good management synergies. Last but not the least, coming to the financial energy, the acquisition of Endurance will create significant value creation for Bajaj Auto in terms of accretion and goodwill creation, which will be witnessed in the further slides. Now coming to the valuation of Endurance. So basically we approached a blended approach in which we first began with estimating the SCFF based DCF valuation, in which we basically our DCF valuation was a two-stage valuation, in which the first was the year-on-year projection up to till financial year 2026, and the second was of a constant growth of 6.37%. So basically, to calculate the beta for Endurance, we did a regression analysis against the Nifty 200 and came up with the beta value of 0.55. Moreover, coming to the WACC estimation, the debt to equity proportion was 38% debt component and the 62% that equity component in the Endurance. Coming to the terminal growth, we derived the key factors that will be driving the terminal growth for Endurance. So based on that and weight allocation as per analysis, we came at a terminal growth of 6.37%. Finally, we came up at a valuation of 1,649 rupees, which gave us an upside of 18.7%. We have also done a sensitivity analysis to account for the any intricacies related with the WACC as well as the terminal growth calculation. Now coming to the relative valuation, we first began with listing out the peers based on the business segment similarity. We opted both EV and price multiples to allow to value Endurance. Coming to an overall basis, we assigned a 70% weightage to our price multiples and a 30% weightage to our EV multiples to come at a valuation of 1,676, which gives us an upside of 20.68%. So it basically a relative valuation complements our DCF valuation. Now coming to our closing thoughts on our valuation, we assigned a 40% weightage to our FCFF based DCF valuation and a 60% weightage to our relative valuation. The rationale being to account for the element of assumption and the judgment that comes along with the DCF valuation. So finally, we arrived at a price of 1,665 rupees, which with a purchase premium of 19.89%. Now, Sanjay will take over.
Thank you, Akshat. So highlighting the acquisition analysis, firstly, we highlight the financial profiles of both the buyer and the seller. Buyer in our case being Bajaj Auto and seller in our case being Endurance Technology. After highlighting the financial profiles, we come up with the transaction analysis. We took the per share purchase price to be 1,665 that came through our relative models as well as our DCF model. And we chose stock to stock, 100% stock to stock model for two reasons, namely, before starting this analysis, we checked the precedents of how Bajaj Auto has been dealing with when it comes to acquisitions. So we came up with two precedents. Firstly was it acquiring Ducati, it going with alliance for Ducati, and second one, it Bajaj Auto claiming a 48% stake in, I think, KTM. So that were two 100% stock to stock transaction. And moving along in the lines, we chose it to be a 100% stock to stock transaction. Then again, we check the precedents not only for Bajaj Auto, sorry, but for the entire automobile industry. And we delve into finer details of acquisitions of, let's say, JK Tyres acquiring Cavendish, Mother Sumi acquiring Abramco and other units. And based on that, we came out as a revenue synergies to be 2%, the COGS OPEX synergies to be 2%, and revenue synergy cost to be 13.5%, all increasing at an annual basis of 0.5%. Based on these transaction analysis and assumptions, we were able to create a combined income statement as well as a combined balance sheet and did a cash flow analysis as well for the new entity when Bajaj acquires Endurance Technology. And then based on our calculations, both for BS and IS, we came up for goodwill creation and balance sheet. The equity purchase price earlier was 1,94,557. The stated figure is in rupees millions. And the total allocable purchase premium came out to be 1,60,676, again in rupees millions. And this was fragmented into three sections, being fixed assets, intangible assets, both being write-ups, and the total goodwill created, which was adjusted in our income statement. Now, based on our highlights, we saw that the accretion percentage came out to be 48%, moving to 55%, then 49, then 42, and 38. This was in line with the accretion, with the EPS of Bajaj before the acquisition, but the number has turned significantly large, which was the first green flag that we got in this transaction. Moving ahead, we highlight the revenue, the sensitivity analysis for revenue synergies, COGS synergies, and OPEX synergies, that how the accretion percentage would have changed had our estimates for the synergies would have changed. And these three graphs represents our green flags that owing to the acquisition, we see revenue enhancement, we see COGS savings, and we also see OPEX savings on the whole. To finally benchmark and entrench our claim that this is a good transaction. We also went through the financial analysis of the combined of the after the acquisition, basically post acquisition, that how the Bajaj will be doing. So we did a before and after kind of an analysis, and we saw that the liquidity position, considering three ratios, current, quick, and cash ratio, all the three were increasing and showed steady numbers for the current year as well as the next year. Profitability assessment, we considered 4 ratio. All 4 show steady numbers, and more importantly, they were sustainable. Last but not the least, the FCFF, EPS, and net income before and after transaction, if we compare, we saw a very significant increase. But there, if you can see this green line, the increase is at a decreasing rate. But this is, however, not a concern. This being the entity has become so large that the growth rate was bound to decrease. But over the years, we expect that the growth rate to become stable. All in all, based on our research, estimates, precedents, and analysis that we considered, we gave a positive rating to this entire transaction. And that was all from team non-performing assets. And we are open to questions. Thank you very much.
Thank you, team. Yes,
Good.
go ahead.
Okay, good work, guys. I just have one or two queries, that's it. The first one is, see, this endurance, currently it is getting 55% of its revenue from Bajaj. Other 50% is from other businesses, right? Now, if Bajaj acquires this, what would Bajaj do with the other 50%? It can utilize only 55% of the capacity, right? So what you are going to do with other 55%, other 45% of the revenue? Are you going to supply it to your competitors? No,
Yes,
your
sir.
competitors might stop, procuring from you.
So we will continue supplying to our competitors because
how competitors are going to react to this? Because see, when you are supplying original equipment, so you have to, they will give you, their designs, right? Only based on their designs you have to supply. Now you are a competitor, you are a direct competitor. Once you acquire that, you are going to become a direct competitor. Do you think they are going to give their designs to you?
Sir, of course, that will be a case, but considering the expansion of Endurance, since it operates majorly in India and Europe only, so there will definitely be a market diversification opportunity which will be there, and Bajaj will definitely be, going with that forward. So that will definitely, a competition, as you have clearly mentioned, that will be a setback. But on an overall basis, if we see on the longer picture, definitely there are synergies that will come into play, and Bajaj will be able to do better.
But, Endurance is going to lose 50% of its revenue if it merges with, Bajaj.
So basically, Endurance Limited deals in aluminum casting, braking systems, as well as transmission system. So these components are actually taken from the component manufacturer only. There's no proprietary technology of the OEM involved in making these components. So I do not think the competitors will have any problem in posting.
It doesn't work like that in the industry. See, you are. You have a particular model. That model requires some specific, components, right? You cannot use a general component for a specific model, right?
Yes, sir.
So when they are giving order, they will give that, okay, this is the dimension, this is the thing, this is all the things you have to meet. So, okay, all right. That's the first thing. Second thing is, so what was your cost of capital you used to discount the cash flow?
7.17, sir. Overall.
7.17 and
yes,
the beat of 0.55.
0.55.
Right?
Yes, sir.
No, and this industry is highly cyclic in nature.
Definitely.
0.55 means it is almost, what is that? Immune to changes in market. No, don't you think that's very unrealistic?
Definitely, sir. So we accounted for that, but basically we did a regression analysis, and that was the value that we came up with. So, like,
that's okay. See, regression analysis will give you some value, but you have to interpret the value, right?
Definitely, sir. So on we also checked for that, like on the average, if we see for the industrial beta, on a global level, it came out to be around 1.15 the beta value. And in terms of Indian auto ancillary company, the average was around somewhere around 0.8 to 0.75 in this range. So definitely the beta value was less for this, but like we had to incorporate whatever we estimated in the model. So that is why we did for that.
Okay. The last question is, go to the last slide where EBIT margin is given. 13th.
Is it visible?
Yeah, it is visible. Look at that. Your EBIT margin, you are expected to be somewhere around 10%, right?
EBIT margin, yeah.
EBIT.
Yes, so this one, yeah.
Yeah. Which one is net profit margin? Net profit margin is somewhere around 10%, right?
Yeah.
So that is, so if it is somewhere around 10%, then don't you think it is too less? Because you are taking so much of risk, but you are going to get 10% return on your equity. Right?
But
essentially, net profit is equity only, right? It goes to equity holder.
Absolutely, but sir, but just highlighting point here, you are saying the percentages. But if you see on this basis, the net income has increased substantially.
So
compared to Bajaj, it was
net profit is on sales revenue, right? And return on equity would be definitely much higher than 10%.
No, but you are showing PAT. See, your net income is increasing, and your PAT margin is 10%. I am not interested in how much is my net income on absolute basis. I am always interested in relative basis. So PAT margin is relative, right?
But sorry to interrupt, but the thing is, the base is also increasing. That is why the number is low, because after the acquisition,
it doesn't matter. See, when you are taking margin is a relative term, right?
Yes, sir.
Yeah. It is 10%. But your base is increasing, your net income is also increasing. So in relative terms, it is somewhere around 10% only, right? So 10% on equity investment. If you keep your amount in a bank, you'll get 10%. So, all right, but good work. Okay, keep it up.
Thank
all
you.
the best, guys.
Thank you so much.
Thank you, sir. Thank you, team. So for our next presentation, we have Team Oracle from IMT Ghaziabad. Yes, you may share your screen.
Please go ahead.
Yes, sir. Give me a minute.
Sir, I think there is an issue. Can we present? He left. Somehow he left the meeting.
There is some issue?
Yes, sir. There is some issue with my teammate. Can we present next? Sir?
Okay, sure. I think Vishaka, they got some issue.
Yes, sir. Yes, sir, sure. Suresh, you can call the next team.
Yes, sir. So calling the next team, we have Team Alpha from NMIMS Bengaluru. Can you please raise your hands? Team Alpha, are you there? I'll just check. Sir.
This is Team Oracle here. We are resolve the issue. So can we present now if that's possible?
Yeah, for sure.
Okay, thank you. Is it visible now? PPT?
Yes. You can start now.
Yeah, good evening, everyone. Today we, the team Oracle from IIM Ghaziabad, are here to present the acquisition of Bajaj Auto Limited and Endurance Technologies Limited. And my team consists of myself, Mopuri Rakesh and Manish Kumar. To summarize the deal, this acquisition of Endurance Technologies by Bajaj Auto Limited is a vertical backward acquisition, which should give the acquirer Bajaj Auto Limited increased control over its input parts for manufacturing. And our recommendation is to acquire 100% stake in Endurance Technologies Limited and maintain as a separate entity by a 100% cash deal financed through debt with 36% premium to current market price of Endurance Technologies. Next slide, please. Coming to the overall industry overlook of auto industry, the key growth drivers of this industry are sales in the rural is expected to increase due to rising income on account of improving agricultural productivity, and government income support schemes are also would also contribute to increased demand, and electrification of vehicles would decrease the total cost of operations compared to its internal combustion engine counterpart, thus making it a preferable option. And the key concerns in this industry are semiconductor shortage, soaring prices of fuel and components, and uneven rainfall. Next slide, please. Coming to overview of acquirer Bajaj Auto Limited. Bajaj Auto Limited was founded in 1926 and headquartered at Pune, is world's fourth largest two-wheeler and three-wheeler manufacturer, and it has three plants in all: two at Waluj and Chakan in Maharashtra, and one plant at Pantnagar in Uttarakhand. It is leading three-wheeler player domestically and is also the largest exporter in this category. Key growth drivers of Bajaj Auto Limited are: Bajaj Auto aims to outpace the industry in international operations, driven by increased distribution reach and strong product portfolio in premium bikes. And it's focused on electrical vehicle segment by introducing the Chetak e-scooter and going to launch new products in EV sector within the two-wheeler segment as well as the three-wheeler segment. And next slide, please. Coming to overview of Endurance Technologies. Endurance Technologies was founded in 1980 and headquartered at Aurangabad. Is a complete solutions provider, providing end-to-end services by engaging its customers from conception to end-user delivery and also catering to replacement market. The company has a total 25 manufacturing plants, of which 16 are in India, 3 are in Germany, and 6 plants are in Italy. Few growth drivers of this company are: the company is looking to increase its customer base and product portfolio by entering into EV segments, and the company has a significant order volume of supplying components to electric scooter and three-wheelers, with components such as castings, brake assemblies, and suspensions in Europe, which is expected to increase in future. Next slide, please. Coming to the rationale behind this acquisition is that this merger would allow Bajaj Auto Limited to have complete control over the ancillary parts such as suspension, brakes, wheel tubes, and transmission, which are key components to production. And with this integration, availability of products with required quality can be assured, as Bajaj Auto caters to nearly 39% of total sales of Endurance Technologies. And the manufacturing plants of Endurance Technologies are located around the plants of Bajaj Auto Limited. This would decrease the cost drastically, as Bajaj Auto is trying to introduce vehicles in EV segments, and with expertise of Endurance Technologies, it could make it easier. And the company would have a strong aftermarket replacement components for both two-wheeler and three-wheeler segments. And Bajaj Auto having 50% of sales through its exports. After the acquisition, it could increase its presence outside the India or all over the world too. Next, we would see the valuation of this.
So coming to the financials of the company, I will first start with the DCF valuation. So for the DCF valuation, we initially forecasted the future financials of Endurance Technology. And with that, we have come with the revenue growth, which is expected to be at 17% in the coming year. And this is mostly based off the low base that actually happened in March 21, and also an expected increase in demand from both the semi-urban and rural areas. The EBITDA margin and the PAT margin is expected to stabilize at 15% and 9% respectively in the coming years. And also CapEx as a percentage of revenue is assumed to be at the FY21 levels, which is 0.35% of revenues. So next, we calculated the unlevered free cash flows of the company and we projected it for the next 5 years. And for the further years, we reduced the growth rate of the unlevered free cash flows to eventually match the terminal growth rate of 4%. The cost of equity was calculated to be at 9.1%, which was through the model of CAPM. And the WACC came around to be at 8.7%. With this, the enterprise value calculated is at 24,365 crores and the equity value to be at 24,445 crores. The price per share is at around 1,738, which is a 25% upside to the current market price of 1,389. Now coming to the synergies valuation. So for the revenue synergies, we are assuming a 4% synergies by March 25 and 26. This is because it would be difficult for the company to realize the 100% of the synergies. So by March 22, we are expecting a realization of 25%. And in 23, 50%, in March 24, 75%. And by March 25 and 26, we would be able to realize the entire synergies that is possible. And also we're expecting COGS synergy as well because of the marginal reduction in operating and other expenses. This could arise from technology sharing between Bajaj and Endurance, also decreased employee cost and fuel and other costs as well. So the present value of the synergies came around to be at 2,000 crores. This is 11% of the market value of Endurance technology. And with an additional 25% premium that was calculated from DCF, the total premium came around to be at 36%. We believe this is a decent offer that the Bajaj Auto can make to the shareholders of Endurance to actually accept for this acquisition. And we believe this is a fair deal as well. So coming to the deal itself, like mentioned in the previous slides, the purchase per share is at 1,884. This is a 36% premium to the current market price. And we are recommending a 100% debt financing for the deal. This is because of the staying away from stock financing, the company can get away from dilution of shares. And also since both Bajaj and Endurance are practically net debt-free companies, Bajaj shouldn't find much difficulty in raising the debt for this particular deal. And coming to the sources and uses of funds, like again, the sources is through debt financing and uses is both the equity value of the company and the transaction fee as well. And to the right side of the presentation, we have the debt repayment schedule that is about to happen in the next 7 years. So next, coming to the pro forma income statement, we are expecting the revenue to grow at 24% when as a combined entity, and the PAT margin to be at 10% and increase by 1% in the coming years. Initially, we can see there is an EPS dilution. This is majorly due to the fact that there is a significant increase in the interest expense of the company. Of course, this being from the debt that is raised to finance this deal. But once the interest expense is reduced and the bond matures and the company is able to pay off the debt, then we expect the EPS to accrete in the coming years. We have also given the goodwill creation. So the new goodwill created is around 24,690 crores, and this will be reflected in the balance sheet of Bajaj Auto Limited. So finally, coming to the risk management, we have identified few key risks that can arise from this particular deal. One could be the overestimation risk, where the synergies could be overestimated. Another one is operational risk because of the cultural clash and the management clash that can happen, which should be mitigated in the future. And also the regulatory risk regarding this M&A deal and financing risk as well. We have also given some risk management methods. For example, the company can come up with an internal audit committee, which can make sure that the management does not take part in the related party transaction, which can go against the interest of the shareholders. Also, the committee can set up an compliance team as well, which will enable them to meet the regulatory requirements when it comes to M&A deal. So with that, we come to the end of the presentation, and we thank you for the opportunity that is given.
Thank you, team. Now I would like to ask our judge to go forward with his questions.
All right. So can you please go to that goodwill created? Previous slide. Now, you have a book value of 3,562 and a purchase value is 25,513, and you are estimating goodwill to be 24,690. Now, you are ready to pay 25,000 extra on the assets whose book value is 3,562. How you are justifying that much goodwill?
So this is based on the DCF valuation that we got from the company, sir.
No, that's okay. But you are saying that you are going to pay a goodwill of almost equivalent to 25,000 crore when its book value is just 3,500.
Yes, sir.
Now, how do you justify that? The book value is just 3,500 and goodwill is usually a small part of total value. It shouldn't exceed, the overall value.
Yes, sir. Because
look at this one here. Enterprise value is calculated to be 24,365 crores, whereas the equity value itself is 24,455. That means equity value is greater than the enterprise value.
Yes, sir.
Can it happen? See, the enterprise value is equal to equity value plus value of debt. So enterprise value should be much bigger than equity value. Whereas in your case, it's ulta. Equity value is greater than enterprise value. Okay, all right. Go back to the previous slides that revenue. Okay, previous. Okay, you are showing that PAT is 520 crores, right?
Yes, sir. Profitable.
Yeah, aftermarket sales is in million, it is 3116.
Yes,
right?
sir.
That means 311 crore.
Yes, sir.
So this is your sales, 311 crore, whereas your PAT is 520 crore.
Yes.
Now, how can it happen? No, sale should be always greater than your PAT, right? You are earning a sales of 311 crore, and that you are making a profit of 520 crores.
So the PAT margin for the company is pretty low, sir. So maybe that is the reason.
No, it is much higher. No, you're not getting that. Sales should be, much higher. PAT should be a part of that sales. Usually, PAT should be around 15% or 10 to 15% of sales. Here, in case your sales is much lower, whereas PAT is much higher. Look at this. PAT is in crores, whereas sales is in millions. So this is 311.6 crore, right?
Yes, sir.
So there is so much of inconsistency.
Yes, sir.
You're not getting the point.
Yes, sir.
Did you get the point?
Yes, sir. We got that.
Okay, work on that. Oh, good attempt. Okay.
Okay.
Okay. Thank you.
Thank you, sir. Thank you, team. So for the next presentation, we have Team Alpha from NMIMS Bengaluru. Can you please raise your hands? Yeah, you may share your screen. Yeah, you can share your screen now. Yeah, you can start your presentation.
Just a sec. Yeah. So good evening, everyone. We are Team Alpha, and the company we have chosen as the acquirer is Vedanta, and the target is Bpcl. The purchase price of the deal is going to be 91,273 crores, including a takeover premium of 14% over its current valuation, which is going to finance with 55% cash and 45% stock deal. Talking about the oil and gas industry, India is the third largest energy and oil consumer in the world after China and US. 85% of our needs are imported. India currently has a refining capacity of 200 metric ton per annum, which is second highest in the Asia after China. Government has allowed 100% FDI in many of the segments, like in natural gas, petroleum, and refineries. The demand for oil in India is projected to grow at 4% from FY22 to FY30 against world average of 1%. Oil and gas industry is divided into three stages: upstream, midstream, and downstream. So the upstream constitutes the exploration and production of oil, Midstream consists of transportation and storage of crude oil, and downstream consists of refining and marketing of crude oil. Now, the key drivers of oil and gas industries are growing economy and population, increasing oil and gas drilling activities, high quality equipments, and rapid technological advancement. Here you can see some of the upstream and the downstream companies, major upstream and downstream companies in India. Now, moving on with Vedanta. Vedanta has a turnover of over $12 billion, and it's one of the world leading oil, gas, and mineral companies with significant operations in zinc, lead, silver, copper, iron ore, steel, oil and gas, aluminum, and power across India, South Africa, and Namibia. It is present across the value chain, starting from exploration, extraction, processing to value chain addition. If you talk about the revenue breakup of the company, aluminum has the highest share with 33%, followed by zinc with 90%, 12% from copper, and 7% from oil and gas. When it's come to market share of the company, Vedanta has approximately 80% market share in zinc, 55% in aluminum, and 47% in copper. Some of the subsidiaries of Vedanta are Hindustan Zinc, Balco, and ESL Steel Limited. Now, talking about Vedanta oil and gas vertical, Vedanta acquired Crane India in 2012, and Crane India contributes 26% of the Indian oil production, and it's the single largest private sector crude oil producer in India. Its assets are in Rajasthan, Andhra Pradesh, and Gujarat. Current volume production for Crane India is 162,000 barrels of oil equivalent per day. It has 58 blocks in India. Last year, EBITDA was 3,206 crores. The company has gross proved and probable reserves of around 1,200 million barrels of oil equivalent. Now, coming to the acquisition done by company. So Vedanta has a trend of acquiring companies in the natural resource segment across value chain. In 2001, it acquired 51% stake in Balco from Government of India, which is the leading aluminum producer. And in 2003, it acquired 65% stake from in Hindustan Zinc from Government of India, which was a producer of zinc, lead, silver, and cadmium. And 2012, you can see that it acquired Crane India, which is in oil and gas exploration. Now, coming to the target company which we have decided, it's BPCL. It is a PSU which is engaged in business of refining of crude oil and marketing products. It has a capacity of 35 million metric ton per annum, with its refinery located in Mumbai, Kochi, and Bina, which is in MP. It is the third largest refinery in India after Indian Oil and Reliance. It possesses 15% of the total refining capacity. BPCL is present across value chain from petroleum, LPG, LNG, aviation fuel, lubricants to exploration. And looking at the revenue breakup of BPCL, diesel accounts for 52%, motor spirits accounts for 23%, and LPG accounts for 11% of the revenue. Now, if you see at the market share, BPCL has around 25% market share in retail fuel, LPG, high-speed diesel, and ATF. Now, if you look at some of the subsidiaries of BPCL, in upstream it has BPRL, and in refining it has Bharat Oman Refinery, and in city gas distribution it has IGL, Petronet, and Maharashtra Natural Gas. Now, having given you a background of both the companies, given that Vedanta oil and gas exploration business aligns with BPCL downstream business, we would be looking for a forward integration. With the acquisition of BPCL, Vedanta will be able to diversify its business into downstream oil business, which will be a natural hedge against fluctuating oil prices and will ensure that smoother earning for Vedanta. Also, BPCL will save cost due to low-cost crude procurement from Vedanta. Also, Vedanta will have access to BPCL 27 oil blocks, of which 15 are in India and 12 are in overseas. And also, the merger will give Vedanta access to BPCL 6100 LPG distributors in India. Vedanta will also be able to increase its BPCL's gross refinery margin by leveraging the use of technology and making investments towards it. And finally, the combined company will have an enormous balance sheet and which will help them to get access to cheaper capital.
Now, when it comes to synergies, so from the revenue front, they are primarily driven by increase in oil blocks. So currently Vedanta has 27 blocks and it can leverage the new 58 blocks of BPCL to increase its revenue base. Vedanta can also benefit from the massive supply chain to expand its distribution network and thereby increase its market penetration as well. Apart from that, better realization in the gas segment can also contribute significantly as far as the increased revenue synergies are concerned. When it comes to cost synergies, they are primarily driven by low-cost crude procurement, rationalization of employee cost, higher economies of scale, and cost saving due to technological advancement. For the purpose of valuation, firstly, we have used the two-stage discounted cash flow method with growth rate of 10% and 7% for the first and second stage respectively. Some of our assumptions included WACC of 12.69% with risk-free rate of 6.7% and beta of 1.31. The intrinsic value based on our assumptions was found to be rupees 376, which indicated a slight upside of 3% over the current market price of 368 as of 21st February 2022. We also performed the relative valuation and the price as per relative valuation was found to be rupees 398. So the final intrinsic value based on the two methods of valuation was found to be 387. And we also performed a sensitivity analysis using WACC and terminal growth rate as our variables to back our final intrinsic valuation. When it comes to financing of the acquisition, so keeping in mind the minimum cash requirement and the expected stake dilution, the transaction will be financed with 55% cash and 45% stock. And a debt of 45,000 crore will be raised to finance the cash transaction. The swap ratio based on the transaction will be 12 shares for the BPCL shareholders for every 10 shares held by them. When it comes to the accretion dilution analysis, so the transaction will be 4.62% dilutive in the first year, that is financial year 2022-23. However, the EPS will be accretive starting from year 24 onwards with an estimated accretion of 20% by the end of financial year 2026. Moving on to the deal structure. So the 45,000 crore cash will be paid upfront and the balance payout will be based on the following structure. So we have decided specific milestones based on revenue and EBITDA growth rates to track the progress of the acquisition in the first 2 years. The balance payout of 202 crores will be based on the company achieving EBITDA and revenue growth rate of more than 9% in the year 1 and year 2 respectively. Now, looking at the risks that the company faces, so firstly, the decrease in productivity of the employees and integration issues is one of the major risks. This can be mitigated by effective internal communication between the company employees. Second major risk is overestimating the potential benefits of the transaction. So this can be mitigated via the earnouts that we have designed using specific milestones. Apart from that, some of the other risks include risk of unknown violations of legal regulatory environments, risk of technological incompatibility, funding risk, and risk of conflicts between shareholders of the companies, and also the corporate culture clashes. And on considering all these aspects and the risks of the transaction, we are fairly optimistic that this merger would create value not just for the BPCL and Vedanta shareholders, but also for their loyal customers as well. Thank you so much, and we are now open to questions.
Thank you, guys. Good presentation. Can you please go to that relative valuation?
Sure.
Now look at that. Your PE ratio, it is dominated by Reliance Industries. So which one did you take? Reliance Industry has so many things, right?
Right.
Did you take only petrochemical industry, petrochemical plant, or you have taken Reliance Industry as a whole?
So, sir, we have Reliance Industries as a whole. And apart from that, we have also considered other industries in the segment as well. So that kind of
MRPL, again, is only upstream. It doesn't have any distribution channels. That is Mangalore refinery, right?
Yeah.
It is only a refinery. It doesn't have its own distribution channel. So your 4.9x Now 4.98x, that is not an.
So for that, because of the discrepancy, because Reliance is into multiple businesses, so what we have done, we have taken a median P as opposed to mean P. So that's why it's showing five times.
So this 4.98 is not the mean of all these things.
No,
It cannot be the mean of all these things, right?
No,
Because 53 is there, 29 is there. It should be greater than 4.98.
Yeah. So yeah, we have taken median. Yeah, that's a mistake.
Yeah, that makes sense. That makes sense. Okay, good work. Second one is your cost of capital. Again, the same issue. Here, beta is 1.31. Now, that is a levered beta, right? That is levered beta.
Right.
The levered beta based on the existing, what is that, BPCL debt equity ratio, right?
Right.
No, this is BPCL cost of capital, or this is Vedanta's cost of capital?
So BPCL's the target company's cost of capital.
No, then that means what is the existing debt to equity ratio?
It stands at 0.37.
0.37.
Yeah.
So when you are going for that acquisition, you are going to use 45%, no, 55% debt, right?
Yeah, some of them will be through cash, around 5,000 crores, and rest will be through debt.
Again, 50. Let it be 50,000 debt, right?
Yeah.
So 50,000 debt out of 90 means how much? Somewhere around 55%.
Yeah, 55.9. Yeah, around that much.
Right. So that means with your new capital structure, this beta would be even greater, right? Because your beta represent only 0.37 debt to equity ratio or 0.37 debt ratio, whereas the new financing could use somewhere around 52 to 53% debt ratio.
So, sir, the valuation that we have done is in terms of finding the intrinsic value of the company to decide the premium. So this is solely the valuation of BPCL that we have done, and not the.
No. See, when you are, this is okay. This is based on BPCL, cost of capital. You have done that, but you are not going to use the same debt to equity ratio to finance that, right?
Right, sir.
So when you are saying,
the objective of this valuation was just to find out the current intrinsic value and how much premium we would pay over and above the valuation. So looking at the current value is this much, and then we'll calculate the premium.
Good. The current value of BPCL is this much based on this beta 1.31, right? Now, this current valuation will be, worth. That means this would be the worth for you guys if the debt ratio remains constant. But the moment you use more debt ratio, the worth of this would reduce for you. Are you getting that? The value of this is, let's say this pen is 10 rupees. The price of this pen is 10 rupees. For me, the worth of this pen could be 9 rupees, right?
Right.
So BPCL worth is 83,997. That is okay independently. But the worth of that BPCL for you could be different from that value, 84,000. Right. You get the point? Otherwise, it was a wonderful presentation. Okay. So just minor issues.
Yeah, just if you see the cost of debt in case of Vedanta, I think it's much lower. So I suppose that will be taken care while calculating the.
Perfect. Whatever it may be. If it is lower, then your cost of capital would go lower. It will go down. That's okay, but you have to adjust your beta for that new structure. You shouldn't use the old structure for calculating the worth. For calculating the discount rate, you should use the new structure.
Right. So we'll keep that in mind.
All right. Otherwise, it was a wonderful presentation. Okay.
Thank you.
Thank you, sir. Thank you, team, for the presentation. So for the next and last presentation, we have Team Smoke Wizards from IMT Ghaziabad. Can you please raise your hands? Yeah, you can share your screen.
Also, kindly keep your videos on.
Yeah, I will be. Maybe have some networks. Just a minute.
Yeah, you can start now.
Yeah, so good evening, everyone. My name is Ramashan Dikshit, and we are team Smoking Wizards, and we are here to present our case in the acquisition of BPCL by Vedanta. And the team consists of Abhishek Gupta and Mahesh Jattani and myself. Can you please change the slide? Okay, so let's take a look at the deal summary. So let's take a look at the situation over here. So over here the government is seeking to privatize state-run refiner BPCL by selling its nearly 53% stake in the firm. And Vedanta Group is willing to acquire BPCL, which might be one of the nation's biggest asset sales. This will help Vedanta to convert itself to an end-to-end oil and gas conglomerate. So let's take a look at the acquirer overview. So over here the acquirer is Vedanta. So Vedanta established in 1965. Vedanta is an Indian subsidiary of London listed Vedanta Resource Private Limited, and it has operations span across India, South Africa, Ireland, Australia, and it is the India's largest oil and gas exploration and production company. And let's take a look at its financial. So when we take a look at its financial, the EBITDA has been increasing by 99% year on growth, and the ROE is right now is 20.4%. And let's also take a look at the target overview. BPCL established in 1952. It is the India's second largest downstream government-owned oil corporation, and the company has a network of 15,400 fuel stations with 13,648 fully automated fuel stations. And let's also take a look at the transaction details. So we are recommending acquisition of BPCL because it will provide high synergies between both of them, which is amounted to $4 billion, and the high combined EBITDA. And it is also help the Vedanta to convert itself to the end-to-end oil conglomerate. Can you please change the slide? Yeah, so let's take a look at the industry overview. So let's talk about the demand. So the global according to CRISIL, the global oil demand will increase by an estimated 35 million barrels per day to 99 million barrels per day in year 2022. This will help in reaching pre-COVID level. And the growth factor over here will be the economic activity, which will be primarily led by China and India. And the increase in the transportation activity would lend support despite the Omicron variant. Global lockdown heavy lens stringent this year, and hence the impact on the oil demand may not be that much significant. And also let's have a look at the supply side. Unrest in the Kazakhstan and the outage in the Libya, coupled with the rising tension between Russia and Ukraine, would play a key role in determining the oil prices in the coming year. To add to this, it is also estimated that OPEC missed meeting its production target in December, which is also raising concern over other OPEC will be able to comply to the planned increase in oil supply, or whether it will not be able to do so. And let's take a look at the company overview, target company. So the can you give me a minute? Yeah. So BPCL is the second largest PSU refining and marketing company in India. The total capacity of the BPCL is 38.4 million metric ton. And apart from refining, BPCL through its wholly owned subsidiary company recently announced to add 1 million metric ton of per annum capacity of LNG terminal at Haldia at projected cost of 1,097 crore. It will help them to get into the non-conventional sector, including So, and the Bharat Gas Resource Limited also made a capital expenditure of 226 crore in this year. Bharat, which they are trying to establish themselves in the LNG regasification terminal. And BPCL has also formed a pipeline expansion plan with a vision to double its pipeline network by year 2024 to 2025. BPCL is a JV partner with IOCL and HPCL in laying the world's largest LPG pipeline from Kandla to Gorakhpur. Okay, thank you.
Thank you, Ram. Am I audible?
Yeah.
Okay, great. So I'm here to explain the strength SWOT analysis. So first strength, we'll take the strength. So BPCL is the second largest presence in domestic market after HPCL. And BPCL also has the greater presence in non-conventional sources that would give much needed help to Vedanta Limited. BPCL has we'll talk about the weakness now. BPCL is not flexible enough to asset its government as it's a government entity. And even though BPCL is a huge presence in the domestic network, but its operations are limited to India only. Now we'll talk about the opportunities. After acquisition of BPCL, the doors for exports are now open for Vedanta Limited. An increase in oil prices will also help the company to increase its margins. We'll talk about the threat now. Now the world is moving to non-conventional sources, use of energy. There is a threat to current situation in the market as business of BPCL is solely dependent on the conventional sources of energy. Oil prices fluctuation and the high competition is also a threat for company. Next slide, please. Next slide. Okay. So we have calculated the valuation of the company through DCF valuation. We have taken all these given assumptions and we have done the DCF valuation till 2032. So there are 5 scenarios as companies now, company is limited to cash upfront. So we have taken 5 scenarios from 100% mix of equity and debt to 90% mix of equity and debt with a change of 2.5%. So after taking all these assumptions, we have come to the share price of 460 rupees for BPCL. Okay, thank you. Abhishek, you can take over.
So now talking about some synergies which come with this merger and acquisition. So we come around 3 synergies for the M&A. First one is revenue synergies. We think about it will give 5% synergies, 5% of revenues. Total revenues of synergy will come from this merger and acquisition, and that too from the optimizing sales sense of the BPCL retail network, which can be used by Vedanta to increase its network.
Just a minute. Just a minute. Please, others mute. Those who are not speaking. I guess someone's camera is on audio is on unmute. Mahesh, I guess it's you.
Okay.
Yeah, proceed.
Is it okay now? Okay, so some operations synergy which come with this M&A is that there will be I can continue, right? Okay, so operational synergy which comes from this M&A are the improved price formulation strategies. Basically, so the BPCL purchases crude oil from the Vedanta group, and then it operates in its refineries, and by this merger and acquisition, this will be an end-to-end oil conglomerate. So this will flow like smooth for the oil operations, and there will be procurement optimizing, and there will be cost reductions in all functions of the companies after the acquisition. And we seek around 5% synergies of 5% of revenue synergies from this reduction in cost with this M&A. And also the Vedanta is looking for expanding into refineries. So after acquisition, there will be a decrease in capex by both the companies, and as well as Vedanta can sell off some assets of BPCL to gain to get out from the leverage, and also there will be working capital reduction with this M&A. Now looking at the deal structure and financing, so basically we are suggesting that to acquire 75% of total equity purchase of BPCL at a valuation of 12.9 billion. So this deal will be funded 10% with cash, and with the remaining 90% with hybrid of equity and debt. And as for our valuation, there could be a 51% premium can be paid in this deal. And this 75% stake can be bought by Vedanta from 53% of government stake, and the remaining 22% from the open offer in the market. And one of the best things which we saw in this M&A deal is that the IRR coming out of this deal is 22%, and which is way higher than its cost of capital. And that's why we recommend to buy the Vedanta to buy BPCL. Now looking at the financing, we recommend a special purpose vehicle to buy this buy the BPCL, as because there is some leverage analysis on the Vedanta group. So, and Vedanta has 99.99% its promoter stake. That they could not get more leverage, so they can bring in some more investors, which will be interested in this M&A deal, and that they could finance this merger and acquisition. Now, looking at the accretion and dilution analysis of the company, there is a good amount of accretion, like 80% in the first of 2022, and this accretion and dilution get reduced in the further years as the company try to merge itself. Thank you.
Guys, can you please go to your deal structure?
Sure, sir.
This is so you are saying that the purchase price is somewhere around 13 billion. If you convert that into rupees, somewhere around 93,000 crore, right, for 75% stake.
Yes, sir.
What was the enterprise value that you get and that you got?
So enterprise value is around 1,27 crore thousand.
1,27. Okay, of course. So out of this 13 billion, you want to finance, you want to use debt 70%, right?
Yes, sir.
So somewhere around 65,000 crore.
Yes, sir.
Even if you conservatively, even if you assume the cost of debt to be somewhere around, right now it is very low, around 8 or 9% that they would get. But on an average, even if you assume 9% debt, right? Now,
Yes,
what
sir.
could be the yearly outflow of interest? Yearly outflow of interest would be somewhere around 6,000 crore.
So yearly output of interest we have. Yes, sir.
So somewhere around 6,000. You are taking 65,000 crore debt, the average 9%. So the interest outflow itself would be 6,000 crore, right?
Yes, sir.
So do you think this is sustainable?
So yes, sir, because after calculating the debt to EBITDA ratio, so BPCL had a good amount of interest coverage ratio. Before this M&A, it was around 20.98 something, and after this M&A deal,
20.98 what?
Yeah, sir.
Interest coverage ratio.
Yeah, so BPCL, sir.
20.98 times.
Yes, sir. Interest coverage ratio of BPCL.
No, because assuming that the debt is very low in current BPCL, right?
Yes, sir.
Post, you are taking 65,000 crore rupees debt.
Yes, sir. So that would increase our cost of equity, because we are recommending a LBO, means leverage buyout for the Vedanta group. So there will be low requirement of equity and the large requirement of debt from the private investors who will be interested into BPCL. Interest coverage means the interest means the cash flow that the BPCL has, which is used to cover a large amount of debt, and so we are recommending a leverage buyout.
Yeah, go to your projections.
Projections. Yes, sir.
Revenue, this is years or in crores? 4
Yes,
lakh.
sir. Yes, sir. By adding both BPCL and Vedanta, sir, combined.
No. Okay, this is combined.
Yes, sir.
No, I wanted to check only this one. So, what would be the then Vedanta? It has its own debt payment, right?
Yes, sir.
No, that is not given here. Anyway, okay. Why you have not done relative valuation? That's a little interesting. You have gone only for this one, right? DCF method.
Yes, sir.
So relative valuation you have not done?
No, sir.
You should have done that. Okay. So
Yes,
okay, go to your valuation again. Valuation.
Yes, sir.
Again, here you have used a debt equity ratio of 9:3, right?
Yes, sir.
That means almost 45% debt you are saying, right?
Yes, sir.
When you are going for this LBO type of acquisition, your WACC is not going to remain constant, right? Because your capital structure is going to change every year. When capital structure is changing every year, your WACC is going to change every year.
Yes, sir.
Right? So you have used a constant WACC to discount future cash flows, whereas it shouldn't have been the case.
Yes, sir.
You are getting the point or not?
Yes, I got the point, sir.
So otherwise, fairly a good presentation. Okay.
Thank you, sir.
Okay. All right. Thank you very much, guys.
Thank you, sir. Thank you, team. Now I would like to ask my teammate Vishaka to conclude the session.
So to conclude the session, firstly, I would like to thank our judge for today for taking out time and critically analyzing all the presentations. I hope the team takes back all the valuable feedback given to them. And also, I would like to thank all the participants for coming today and showcasing their presentations. And also to thank my team for cooperating and making this event a grand success. And for the results will be declared on the Karmaanta' page. And for that, you will have to wait for a week. And any last words from you, sir, if you would like to say anything.
All the teams have done wonderfully good, especially I don't remember